So building on the theme that I've been addressing this week, which is basically observing this massive sell-off in the U.S. stock market, I saw an article this morning from Zero Hedge that I'll share with you. I thought it was appropriate from this QTR's Fringe Finance. And the theme and the title of the article is "Look the FUCK Out Below." I'll go into that. And talks about it again. It's this whole idea that the mainstream media is always trying to provide excuses why it's a great time to buy, right? You always hear buy the dip, buy the dip. So let me start out by saying the markets just closed within the last 10 minutes. And they sold off pretty good again today. Looks like there was a little bit of a reprieve yesterday. The NASDAQ recovered a couple hundred points, not today. Let me give you the stats. Dow dropped 537 points, 1.3%. S&P dropped 77 points, 1.39%. NASDAQ dropped 370 points, 1.89%. So it gave everything back it gained yesterday and lost more. So far from its top, the NASDAQ is down 14%. I got that from CNBC just a few minutes ago. Down 14% from the top. And the S&P is now down just over 10% from the top. If you follow the small caps, the Russell 2000 is down almost 19% from the top. But let me share this article with you in a few minutes. And what this author is saying is this may not even be the tip of the iceberg because things are so valued, the metrics are so overvalued right now in the market. Again, I'm not a market. I do observe. I have a lot of friends in the market. I pay attention. But if you guys have a different perspective, once I share the story, please let me know. I know a lot of you guys are heavily in the stock market and are heavily biased towards the stock market, which is fine. Hopefully, you guys that are in the market are smart enough to have hedged your downside risk and you're not hemorrhaging too badly. I've got some friends of mine that are losing pretty good dollars right now. Gold is up $50 an ounce today, 50. Just below $3,000 an ounce. We're interested to see when gold does hit $3,000 an ounce officially, if the mainstream media starts to pick up on it again. It'll be even more interesting to see if the public steps in, starts buying while the price is going up, right? Which is the opposite of what they should have been doing, buying when the prices were down. I pulled some data this morning. This is before today's close. And it said so far this year, $5 trillion, I'm sure it's more as of today, $5 trillion has been wiped off of the stock market in wealth. And I had a friend of mine earlier I was texting with who's in the market. And he said, the wealth effect does really matter now. And, it's very interesting points. I was thinking that through. These are the people that when they look at their accounts and they see they're down 19%, 15%, over 10%, individual stocks, maybe even more, right? These are the people that will not now go book that first-class plane ticket to take that trip to Europe. These are the same people that will not, go out for the third night this week to an expensive steakhouse, right? They're the same people that maybe will hold off buying that Bentley or that Rolls Royce or that new supercar. These are the same people that employ a lot of folks in the private sector, right? So this is real. This does impact everybody, even if you're not in the markets. Your boss is probably in the markets. His boss is probably in the markets, okay? So keep that in mind. 10-year bond I saw down 4 basis points at 4.27%. Not a massive, let's say, flock to the 10-year as you might expect with this much panic. Okay, we'll see how it plays out tomorrow. Silver up 58 cents as I'm recording the video. It has got just like a cent or two below $34 today and then pulled back a little bit. Silver's got a lot of room to run. It's very undervalued, and I wouldn't be surprised to see this march back to $49, $50 here pretty quickly. Not trading advice, not financial advice. So that is that's the data. So what happened this morning? Treasury Secretary Scott Bessent came out this morning, and this kind of started the ball rolling downhill again and said Thursday the Trump administration is more focused on the long-term health of the economy and markets and not short-term gyrations. He says, quote, "We're focused on the real economy. Can we create an environment where there are long-term gains in the market and long-term gains for the American people?" Bissett said on CNBC's Squawk on the Street. He says, "I'm not concerned about a little bit of volatility over 3 weeks." So a little bit of tongue-in-cheek there, but this is consistent with the administration's theme that they are no longer, there's no Trump put, if you will, in these markets like there was in the first term, all right? And so there's this sentiment shift. I talked about it in a show a couple days ago that, hey, how far down is it? A friend of mine yesterday texted that, there's a floor in these tech share prices now, time to buy. My response was, how do you know that? What are you basing it on? When you're talking about PE ratios, and we'll get to that right now, that are, 40 times, where is the bottom? So that segues me into the article. Look the FUCK out below, again, to give credit to QTR's Fringe Finance. And, when I do watch CNBC, I don't watch the news channels very often, but when I do catch it, you do see these hosts, Mark Faber and these guys. Is it David Faber or Mark Faber? I guess it's Mark. Anyway, I'll get to it in a second. But, always, the guys on the mainstream financial channels, Jim Cramer, always saying, hey, this is a great opportunity now. So this guy says, I detailed this both in my March market review and my piece explaining why I think the next crash could very well be different from those of days past and could break the brain of market participants. And he says, I wasn't going to write a piece midday today. This was posted this morning at 5:05 a.m. I think he's talking about the market about a day and a half ago as he's observing this. And of course, now it's sold off even further, so it's even more appropriate. He said, I wasn't going to write a piece midday today until I turned on the television, and despite the best efforts of David Faber, to inject some semblance of reality into CNBC guests, watched portfolio managers justify paying 26 to 40 times earnings for tech stocks that they said are on sale. Thank God I hadn't eaten lunch yet, or I may have heaved, he says. He says, first, let's keep our bearings about us. Keep in mind that over the past 5 years, the NASDAQ is up 140%. He says, those are astonishing returns that, in my opinion, have been fueled by insanely euphoric expectations, arrogance, hubris, a relentless passive bid as a result of COVID liquidity, and weaponized gamma in the options market. It was a combination of these three things, in my opinion, he says, that led us to so far overshoot the euphoria mark on pretty much all valuation metrics, which is how we got here. And he shows the Buffett indicator and the price to earnings model, both of which he explains are strongly overvalued. Buffett indicator is the ratio of total value of U.S. stock market versus the most current measure of total GDP. When the value is very high, it suggests the stock market is overpriced relative to actual economic productivity. And he says the PE ratio model tracks the ratio of the total price of the U.S. stock market versus the total average earning of the market over the prior 10 years. Both, he says, according to the charts he puts up, show a strongly overvalued metric. Buffett indicator on top, price to earnings model on the bottom, okay? He says, today when I turned on CNBC, I actually saw it could be Faber, doing a great job trying to keep some semblance of reality and talking about how things were cheap, right? He said, just take a long-term view, one of the analysts said on the TV today, telling Faber he was directing his trading team to buy more Microsoft while on the air around lunchtime. He says there's a psychological shift now taking place deep in the foundations of the market. And we talked about this phase shift idea on a couple days ago on the show, if you happen to catch it. He says not only where people are beginning to entertain the idea that we're entering a bear market, but also simultaneously entertaining the idea of a rotation out of risk-on speculative U.S. technology stocks and into both U.S. industrials and emerging markets. A sentiment, he says, I have been predicting would take place dating all the way back to the beginning of last year. He goes on to say, with that being said, the sentiment I'm seeing on financial news and social media isn't anything near, this is where I want you guys to cue into this, all right? Anything near what I would consider capitulation, and therefore some type of psychological bottom. As far as a bottom for fundamentals, the market could easily get cut in half in here and still not necessarily be cheap. Listen to what he says. The market could easily get cut in half, with meaning 50% loss from here and still not be considered cheap. I think we all know the Federal Reserve likely won't let that happen unless a massive deleveraging runs wild and creates a one-off crash. So he's saying, well, the Fed, if it gets too bad, will step in again, okay? And of course, the markets are hoping or they expect that will happen at some point. But let's say valuations come in at 20% to 30% on 25 or 26 times earnings. This would be an area where I would start to also want to gauge psychological sentiment, he says. Right now, all these, calls them crumb bums, all these crumb bums, they're flapping their gums all day on CNBC, are fighting this trend of the market moving lower. It's just one excuse after another, he says. It's a great opportunity to buy. They clamor. He says, yeah, with little or no acknowledgement of how overvalued everything is. The potential for the market to move lower, or things like private credit markets and commercial real estate, among other time bombs that may be waiting for the market out there as it sells off. Everybody today on TV was trying to fight the market, and to some degree they have to. Most of these people have been on TV every day over the last couple of weeks, telling everyone to buy as the market moved lower. And so what other options do they have? Admit they were wrong. He says that's never going to effing happen. All right, let me close here. I'm going a little long, but I thought this article was just so on point. He said, instead, we get every possible mental gymnastic contortion of reality and bullshit, excuse available as to why today is definitely going to be the bottom, at least until tomorrow. And investors who are savvy enough to take a long-term view should view this as an opportunity. He says, nobody ever asked a question like, what happens if the S&P reverts to an average P ratio of 18 times earnings for the next decade? In that case, he says, it doesn't matter whether you have a 1-year, 5-year, or 10-year outlook. It's not an opportune time to buy here. End of story. And I've shared this before on the channel with friends of mine that got caught up in the dot-com bubble and lost most of their net worth. Their portfolios never recovered because they rode that thing so far down they didn't have enough to reinvest. So, he's saying, what if we return to 18 times earnings versus where we're at right now on some of these high flyers at 40 times earnings? He's saying you can't buy into this whole take a long-term approach. He says, what I'll be watching for is when the very same huge-brained analysts on TV arguing that expensive stocks are cheap finally surrender and admit that this market is broken and it's different this time, but only to the downside. When these people are finally liquidated and some firms start blowing up, when anchors, what their pants and run off the desk on live TV, says, maybe I'll start wondering whether or not market psychology has changed. I really enjoyed reading that this morning, and that was when I think I read this article before the U.S. markets even opened today, and then of course I watched the continued sell-off. So look, I'm not rooting for losses. I'm not rooting for anybody to get hurt, on these markets. Again, if you guys are smart in the markets, you obviously or presumably hedge yourself to the downside. and you're not only making money when the markets are going up. I'm going a little long today, but it's a big day. If you're in the markets, it's a big day, but everyone, all of us should pay attention, okay? Thanks for watching. Thanks for supporting the channel. Thanks for subscribing. If you haven't, please hit that subscribe button for me. Talk to y'all soon, okay?